So I went for an outstation trip for about 5 days, and today I just got to enter my office slash studio. And during the past 5 days, a lot of things have happened. Basically, the CPI of 9.1% is being announced, and then the US dollar strengthened against the euro, and basically the euro USD is right now at a parity, which has not happened for the past 20 years. And the cryptocurrency market has been doing quite well, surprisingly, perhaps due to the optimism that the Ethereum merge could possibly happen by mid of September. And there are a lot of things happened during these 5 days. I couldn't make a video during that trip. And right now I'm back in my office and I can start producing some videos for you guys. But in this video, I'm not going to share with you the nitty-gritties about all these news or whatnot. What I'm going to share with you is basically, at least to me, why these economic data do not bother me anymore, at least at a practical level. Now, I understand that learning a little bit of histories and understand the statistic and what's going on around the stock market or crypto market or financial market in general can be really helpful, or can be it's like some people find it very exciting to learn all those stuff. But I'm going to share with you in this video why, to me personally, they do not matter at the practical level. So I'm just going to make this kind of different style of content for this video and just try out, because I just got back. I need to clean up the office, do a little bit of, arrangement and things like that. And I do not have a proper setup just yet. So I just pop camera on and mic up myself and start recording some content for you guys. So it's more like a vlog style because I still have a lot of things going on. So I'll just spontaneously share my opinions about what's happening. So today's opinion piece will be why I do not really care about those economics data. And check this out. Bitcoin has been going up by about 10% for the past 7 days, while Ethereum has been going up by about 40%, now 38% for the past 7 days. And it is really, when I'm not in my hometown, in my office, things always get very interesting. I have this mining rig lying in my office. It was the mining rig that I built for the mining rig build tutorial, and it is running on Wi-Fi adapter. A lot of people will criticize about that, but the StyleShare is fine. And during my outstation trip, all the mining rigs, including this one, is making me more money because the price of Ethereum has gone up and the difficulty level basically stays the same. So that's the reason why I like mining. Passive income for the win. Just like companies' account, economics data can be manipulated as well. Now, just take CPI for example. So CPI is basically being constructed by measuring the price changes of a basket of consumers' goods. Now, take these 2 cans of drinks for example. So for example, these 2 cans of drinks, maybe 1 month ago, this was $1 and this was also $1. And maybe previously this was being included into the CPI calculation. And for the past 1 month, this can of drinks has been going up in price from $1 to $1.20, while this one went up from $1 to $1.10. Now, previously, this was being included in the CPI calculation, for example. And right now, the authority can just be like, if we were to include this into the calculation, then the CPI outcome will be higher. So what they can do is, instead of including this consumer's good, they replace this, which is having a higher price increment, with another one whereby the price increment is lower. Now, with this, the sort of like data can be manipulated. So at first place, CPI is already not a good representation for every household, because you and I, we are going to have a different spending pattern. You might not be drinking these drinks. For example, you might be drinking other drinks that is maybe not being included into the CPI calculation. So that is not a good representation at first place. Now, what's make me care less about these kind of data is that they are all delayed. So the economics data that released this month is actually not what's happening right now. It is going to be scenarios or things or circumstances that have already happened in the past couple of months or past period. They are not recent. It just tastes great. Japan number one. Is that true? All right. Not sponsored, by the way. Data is always delayed, being economics data or even financial data of certain companies. And a lot of time, we just have to understand that at a practical level, stock market is a leading indicator of everything. And the stock market has been down year to date by about 20%. We are definitely in a bear market right now. And the market basically peaked at January this year. And then after the market peaked and started going down, then only we get to know all those economics data like high CPI and all those things. And people are just like overly obsessed with the data and chasing data after data. And probably one of the things that a lot of people are waiting right now is whether or not we are going to post a negative GDP, for the second consecutive quarter. And we are about to know in a couple of days. But with all being said, we already know that the stock market actually reacted before all those so-called bad economic news is being announced. So the reverse can be true as well. Before the authorities, before everyone else posted a good data signing that the market might already recover, the economics is getting better and better and things along those lines, stock market will probably already bottom out and starting to go up. So this is exactly why a lot of time myself, I'm not really care about economics data, because from my experience, the market is going to go up right before every good data is being announced and posted. It's going to be a very busy day. Got another call and I have to go to another office to do something. That's the downside of, going outstation. So hopefully later I can film the rest of these videos outdoor without going back to the studio, because I just do not really want to hop back to the studio right after finishing the administrative tasks. We shall see, because the weather is a little bit hot. I would like to see if I can find a spot that I'm comfortable to, to film. So I just reckon why not I just grab a coffee and then continue talking about what I want to share in this video. So again, there's no financial advice in this video. They are purely my opinion pieces and things that I personally practice and my personal preferences or opinions. So do your own due diligence before you make any financial decisions. So you might be asking, now Jin Hao, if you are not relying on the economics data because they are delayed, they can be manipulated. So as an investor or trader, then what should you do, or at least what I personally do or practice? Now, when it comes to this, I think that there are two ways of going about this. Now, the first one would be you're going to create an investment plan that will allow you to stay invested and continue investing, meaning that putting more into your investment portfolio along the way without timing the market. Because the first thing that we as an investor need to know is that if you are investing into quality ETFs like the S&P 500 index ETF or the NASDAQ 100 ETFs or any high quality ETFs, these ETFs are designed to go up in long run. Specifically, if we are talking about the S&P 500 index ETFs like the SPY, these things are going to go up in the long run. So bear market is going to be temporary. Now there can be like half year, or they can last for a year or longer, but it is just a matter of time. Market will go back up. Policy makers are very, aggressively and actively trying to solve all the issues around us. It's not that just you and I are facing, financial problems or distress. There are a lot more people who are facing even tougher times and greater issues than us. So the policy makers, they are doing the job. Everything would take time. But the thing that we have to know as an investor is the market is designed to go up in the long run. So essentially what you need is a solid investment plan that ensures you to stay invested, and stay invested is the first one. The second one is being able to commit even, more investments or capitals into that long-term portfolio. And this is where strategies like the dollar cost averaging comes into play, or even things like value averaging, or people like to doubling down when the market go lower or drops by certain percentage. But before crafting this kind of investment plan, you gotta know what you want to do and why are you setting certain percentage. Now, DCA can be very common nowadays. There's one thing that I particularly want to talk about is doubling down for X amount of drops in the market. So personally, I double down when the S&P 500 index, specifically this index, when it drops from the all-time high by 10%, then the next level will be 20%, then 30%, then 40%, then 50%. So you got to understand why I crafted this is because it is based on how much the S&P 500 index can drop, potentially drop, or has dropped in the past recessions. So we are now only at the second doubling down level that I will call, which is -20. It hasn't even reached like -30. So to me as an investor, this part, I'll just stay invested. And if the market were to go even lower, I will double down. But I will only double down when it reach my predetermined threshold. It is going to be a properly crafted investment plan. It's not going to be occasions like, okay, I feel like the S&P 500 drops for X percentage. In this week, I think that it is low enough, then I buy a bit. It's not going to be that kind of, impulsive purchase in the share market or stock market. So it's not going to be that. I'm talking about investment plans that are properly crafted in a way that you do not do market timing as an investor. Now, the second way would be more towards trading, and that requires you to learn one technique called technical analysis. And this is specifically why I get into technical analysis, because the market is very unpredictable. Things often go down before all the bad news are flooded in the market, and also the market or the companies will recover before all the great data are being posted and made available to the public. So I strongly believe that before the market even, recovers, fundamentally recover, the stock market will react first, because that's always the leading indicator of the entire economy. And we got to understand that in the financial market, we are dealing with everyone's expectation, and all these expectations are being factored into the market already. It has already been priced in. It is just like right now, Ethereum has gone up quite substantially for the past couple of days or a week. The reason could be because the optimism of Ethereum merge that could potentially happen on mid-September. So this part has already been priced in. Now, what if the merge does not delay and go according to this timeline? I guess things will just remain normally because things has already been priced in, or even people might sell on news. But what if the merge is being delayed again? Now, I suspect that if that would happen, understand that the merge on September has already been priced in the market. So if it were to delay again, expect one sell-off because the expectation just fell and people will sell. Now, when it comes to stock market, it's exactly the same thing. So right now, the stock market has already priced in that inflation is going to be like super crazily high. And you know what? They are also expecting that the rate hike will be very aggressive, up to like 0.75% to 1%. So things are really rough, but all this roughness has already been factored into the market when all these bad news has already been digested by the market. The downside would be pretty limited. And when all these things, things have an equilibrium. And when all this cannot get even worse already, yes, the following quarters or months data will be bad, but you will realize that things might reverse back up in terms of price. So in this regard, technical analysis will really help you to determine whether you should go long or go short in the market. So by learning technical analysis, you will be able to follow the trend. So since the beginning of the year, the market has been trending down. So our primary focus would be going, short on the market, but with inverse ETFs personally, and also find other stocks that are performing the market to go long, of course, like the energy stocks that I have previously mentioned. Now, speaking of energy, there's one thing that I want to comment. I personally think that the prices of commodities are going to be a leading indicator of inflation goes down. Here's the reason. Energy prices can be said as one of the culprit of the sky-high inflation right now. And the reason why people have already expected a very high CPI to going to be released this month is because last month, the oil price is still high. And right now, oil price has started to come down. So in the following months, probably we are going to see, oil price trending even lower, and potentially this could be the end of high inflation. And these are just my guess, although they are, somewhat educated guess, but it's still a guess. As far as the stock market is concerned, I really follow the trend. So at the point of recording this video, I understand that the S&P 500 and all the major indices has been going up a little bit, but overall the trend is still weak. I remains neutral at this point of time, and I stay invested for my investment portfolio. And for the trading portfolio, I am properly managed in a way that I understand what's my risk per trade for my inverse ETFs and also some of the stocks that I'm holding to go long. So you need to understand that, okay, technical analysis is considering and factoring, okay, all those news and whatnot, and also things that maybe we all haven't known just yet, and they're already being priced in. And that's why we are using technical analysis to follow the trail or traces of those price movement and make buy and sell decisions based on it. So I am really not a news-based person, and I'm really not a fundamental-based person, because I clearly understand that news, data, just like companies' accounts, can be manipulated in a way that they present things that are greater than, nicer than what it is. So just like the CPI data, if you were to tell me that the real inflation is higher than what the CPI has reported, I truly believe that, because I don't think that inflation is only 9.1%. So there are a lot of things that we cannot truly nail it when it comes to the fundamental side of a lot of things. So that's why I'm not really a fundamental guy. I'm not a news-based investor or trader. So for investment, I create a plan whereby I do not have to time the market, be it ETFs or individual stocks. Now, when it comes to trading, definitely I'm just following the trend, and the trend is our friend. So that would be all for this video. It's basically just my opinion piece, sharing with you guys why I don't really bother about economics data anymore. I do still read but I'm not heavily relying on this data by all means. And yeah, that will be all for this video. If you like this kind of random, freestyle, spontaneous kind of, or even vlog style of content, remember, hit the like button and also subscribe to my channel for more information just like this one. With that being said, let me enjoy my coffee and the sea view, and I'll see you when I see you. Peace.